Okay, thank you. That was a good try, Clinton. Maybe I can see Gina. Gina, Kimberly, you can also give it a try. Hi, Gina. Okay, Gina is not in a position to talk seemingly. So maybe I am not well conversant with all members or all participants of the meeting, but I let me request Eugene again to try explaining whatever he understands by this image before we continue. Hello, Eugene.
Yes, definitely.
Okay.
So,
Yes, please explain.
according to me, I think cash flow, um, at the source we have somebody maybe has the tap, and of course we can take the assumption that that's the source, and in between there's somebody who is holding up, and on the other end is there's somebody who is receiving. So I might want to insinuate that this is a control measure, that there's somebody at one end receiving directions, and they are probably working as a team collaboratively to decide on what to do. Yes, maybe that might try out. See.
Okay, thank you. Thank you so much, Eugene. Yeah. So, in my opinion, seeing this tap, the five and the person on the other end who is looking at things coming out of the tap, I I really get to understand uh, that cash flow cannot happen without involving people. Like someone must be involved for money to come in or out of a company. And you can even see next to that image there's an explanation that the net amount of cash and cash equivalents being transferred in and out of a company. Meaning, when you look at the in part, we see the person regulating the tap. And then the out part, we see the lady looking at things coming out of the tap. And then the person supporting the pipe is now the in-between guy, the transfer process, the one in charge of the transfer process, the process in between cash in and cash out. Yeah. So just to move on to the next slide. Yeah. So allow me allow me define the terms that you're going to interact with, because I don't want to assume that everyone in this meeting has knowledge about cash flow and matters asset liability management and liquidity risk. Yeah. So when we hear the term cash flow decline, it means that there's something that has reduced. Yes, for something to decline, it means there's a reduction. So this is a reduction in the amount of cash generated in a business over a specific period of time. Yeah, and this reduction you can see it by looking at your operating activities, your financing activities, your investing activities. All those activities result to cash flow. Yeah. And then we have asset liability management. Asset liability management is a practice used by financial institutions, but it cannot be financial institutions only, but this financial institutions is included in this definition because they are the most people that usually use asset liability management. So this is a practice that is used by those financial institutions to mitigate financial risk resulting from a mismatch of assets and liabilities. A mismatch of assets and liabilities basically means that either your balance sheet or your statement of financial position is failing to balance. And for it to fail to balance, it means there has to be a problem that is resulting to that mismatch. It's either the assets are less than the liabilities or vice versa. Yes. And then to describe liquidity risk, this is the risk that a company or financial institutions may encounter um, difficulties in meeting its short-term financial obligations due to an inability to convert assets into cash quickly at a reasonable price. Here, whatever the definition basically means is that that company or entity or that specific organization is not having liquid cash. Yes, they don't have assets that can give them cash faster when they need it. Yeah. So due to the presentation, that's before I look at the strategic analysis for cash flow decline and so forth. And for us, or ideally for us to understand asset liability management and liquidity risk, it is very vital um, in uncovering the business weaknesses, and you can confirm that if at all you have a business or you're a business owner or you work for a particular business, you can attest that understanding this ALM and liquidity risk is very vital. And therefore today's topic is very crucial for all the professionals we have here, and because it directly impacts our companies and our company's financial health and resilience. It also involves an in-depth analysis, I would say, of cash flow and strategy in decision making in matters finance. Yeah. And throughout this presentation, you will see us explore practical examples and provide detailed insights into managing these critical aspects of our business operation. So for you to analyze your cash flow decline strategically, you first of all need to do a thorough assessment. Yes, by a thorough assessment, I mean you have to look at your business very well and then pinpoint the causes of your cash flow decline. An example is when you go to an hospital for a doctor to help you, you will be asked questions, and these questions are just to help the doctor get to know what might be the root cause of what you're suffering from. Yes, and it is very crucial to have that doctor make a decision on which medication will suit you well. That is the same case with our businesses. If you have known the root cause of your cash flow decline, then you will be able to make a decision that is well informed and that will help you for the long term business. Yeah. Another thing for you to analyze your business strategically, for you to analyze the cash flow decline of your business strategically, you need to have proactive solutions. And proactive solutions can effectively help you reverse the trend of a declining cash flow to now a growing cash flow. Proactive solutions are solutions that are prompt, that can help your business um, very quickly. We are going to look at those solutions in the coming slides, and we'll get to know how you can make your cash flow decline uh, be reversed into a cash flow growth or positive cash flow. Yeah. Another thing is continuous monitoring. You can't be having a business or you can't be working for a business and you're just there. You're not monitoring how your business is running. You're not monitoring whatever is happening in your business. You have to take your time and continuously or frequently monitor how cash flows into your business to ensure that your business is well sustained and to ensure that the financial health of your business is not at risk at any time throughout your running of the business. Yeah. So In the previous slide, I've just said that we want to look at the solutions for how we can move from a declining cash flow to a positive cash flow. So these are some of the ways we can use to improve our cash flow in our different businesses. Yeah. So the very first one is invoice management. And by invoice management, we have four things that you can do under invoice management. The first one is that you need to send out your invoices promptly. Yes. When you send out your invoices promptly, it means that you will be trying to reduce maybe your accounts receivable, and then now your customers will be getting the invoices on time and starting to plan for their payments early enough to avoid disorganizing you. Yeah. And we also have offering discounts for early payment. If you offer your customers discounts for early payment, it means that they will be motivated to be paying for your goods or your services early enough so that they get the discounts, because we just know the current world or the current generation who doesn't want something that is helping them reduce the burden on their end. Yeah. Everyone will be running towards your business because you offer discounts when people pay for goods early. And then we have implementing clear and efficient billing processes. This is, I think it's part of the internal controls. This should be maybe done by an accountant or your finance persons in your organization. They they need to implement very clear billing processes in that there is nothing that is quite ambiguous, and every step of the billing process is clear to avoid confusions and avoid issues of people failing to pay because the billing process was not clear. Yeah. And then the last one, you need to follow up on overdue invoices and consider using invoice factoring or accounts receivables financing. Yes. When when you follow up on your overdue invoices, it means your credit management is on another level, and it helps you avoid having a lot of your debts outside because you're always on the neck of your customers, just reminding them. Yes, some of them will not like it when you always follow up on the invoices, but it is for the good of your business. Yeah. And the invoice factoring part, you can also agree when your customers bring you an option of maybe sending their invoices to other person, or when their company is being liquidated and they want to send their invoices to other persons, or those persons, so that those persons can get to pay for the amounts they owe you. You can also allow that because it will help you in managing your invoices. Another thing is that you can control your expenses. Yes. When you control your expenses, your cash flow will automatically improve simply because you have identified unnecessary expenses and you have done away with them. So it has reduced your expenditure, and you can also negotiate with suppliers for better terms or discounts because it will be easier on your side. You will benefit a lot from getting uh, affordable terms from your supplier. And then you can also evaluate the cost benefit of all expenditure, including recurring subscriptions and services, so that you always have them in mind. Like if there's something that when you spend on it frequently, or you spend on it recurringly, there's a benefit you get. You can only get to know it by evaluating it, because if you don't evaluate, you will not get to know. And maybe that could have helped you control your expenses, because maybe incurring it continuously is doing more harm than good to your business, and you're not aware. Yeah. Yeah. The next way of improving your cash flow, or just before I start the inventory management part, in case you have a question or there's something you want to add, please be sure to make good use of the chat box. Please utilize it to the maximum. Yeah. So the third way of improving your cash flow is inventory management. By managing your inventory, it means you keep inventory level lean towards the carrying cost. Yeah, if they lean towards the carrying cost, it will be an advantage to you. Okay? Yeah. And another one, you just employ the just-in-time inventory systems. And finally, you can also identify the slow-moving or obsolete inventory and liquidate them. The slow-moving ones are the ones that have just been there in your stock or in your company for a long time. You're not selling them, you're not using them. They're just idling there. Yet you used your money to purchase them, so you can do away with them just to improve your cash flow. Another one is we need to streamline your operations. Yes, under streamlining your operation, you can optimize your business processes. When you optimize your business processes, you reduce those operational inefficiencies that come with non-streamlined operations. And then you can also automate tasks in the workflows to save time and resources. Automating tasks in the workflows means you can employ software wherever software is necessary. For example, in today's world, I don't really think it's relevant for a company to be doing their bookkeeping manually when we have very many accounting softwares like QuickBooks, TallyPrime, Sage, ZeroBooks, Zoho Books. You can just use any of them to make your workflow very, very smooth and make your tasks be handled on time and efficiently. Yeah. And then you can also consolidate tasks and roles to reduce overhead. When you bring tasks together, the roles together, instead of breaking them into smaller units, when you bring them together, it's easier even for the operations manager maybe to follow up or to make sure the operations are streamlined. Yeah. Another way of improving your cash flow is your working capital management. And in working capital, we know that, or not all of us, but some of us, you're aware what makes up our working capital. It's the current asset, the current liability, the current asset like account receivables, inventory. You need to really manage them well for you to improve your cash flow. So under working capital management, you can extend payment terms with your suppliers by making good relationships. When you are maintaining good relationships with customers, even as you extend the payment terms, it means you will take longer to pay for services offered to you or goods offered to you, and then you will speed up the the collection process from your debtors or rather your accounts receivables, and that will be to your advantage because your income will be coming faster than your payables. So, like whatever you owe, you take more time to pay it as you generate more income. Yeah. And then you can also use vendor managed inventory to shift inventory management responsibilities to your suppliers. And that will be also a reduction of the burden on your end. We also have cash flow forecasting. Yes, we know forecasting is looking into the future. So when you forecast your cash flow, it helps you know which cash needs you will have in the future, or which cash needs you anticipate, and it helps you prepare for them and plan for them well. You can also use the historical data and the future projections to predict your cash flow. When you look at how your company has been doing for the last 3 years, and then you also look at where you're going and what you think will be happening in the future, it can also help you plan well and improve your cash flow. You can adjust your strategy based on your cash flow forecast after you have looked into the future and seen all that. But this you cannot do it alone. Yes, if you don't have the capability to forecast your cash flow on your own, you can always involve an expert. Yeah. And finally, how you can improve your cash flow also, you can restructure your debt. debt restructuring is very, very important in improving your cash flow. And under debt restructuring, you can renegotiate loan terms or refinance high interest debt. Yes, to help other terms, lean on your side and be on your favor. Not that you will not pay them, but at least you have negotiated terms that are bearable for you. And we also you can consider consolidating multiple loans into one to simplify the payments, because if you have small loans, it can be hard and hectic to be paid each and every one of them. But if you consolidate the loans, it is easier and very simple to pay them. And again, you can explore options like debt consolidation and other lines of credit. By exploring options, it means you will be spoiled for choices, and now you will have to pick on the best that works in your favor. Yeah. To the next slide. This is leveraging now financial tools and resources. How you can use whatever is around you to improve your cash flow. By leveraging, it means how you can, I'd say, utilize it strategically. Yeah, how you can utilize now the financial tools and resources that are around to help improve your business's financial health. The very first one is knowledge enhancement. Yes, someone else say that every day is a learning day. So if you keep on enhancing your knowledge, it means you will remain very relevant, and you access relevant financial literature and resources, and you get to be well informed in whatever is going on around within and outside your business. And it is very essential because it helps you in expanding your knowledge and expertise in the financial tools and resources. And when let's say when you're starting a business, you are not that well informed in matters finance. When you keep on enhancing your knowledge, by the time your business will be somewhere, you would have been a financial literate. You'll be very well informed, and no one will ever believe that you are one day you are not well conversant with matters finance. Yes. Another thing is continuous learning, which it is more related with knowledge enhancement. You can engage in continuous learning through online courses that are nowadays everywhere in these online platforms. Things like financial modeling, you can just learn them at your comfort in your homes. Yeah. So through this online process, you will stay updated with the industry trends and the best practices. You will be up to date. Yeah. And then the third one is mentorship. Mentorship, you can get guidance from experts. You can get guidance from those who went before you, those who ever had such businesses, and you look up to them. You can just look for them and get guidance from them. You get valuable insights from them, and you get to learn. And by that, you will be able to improve your cash flow in your business, and you will get better financial management strategies day by day. Yeah. Now onto the implementing effective leadership in financial strategy. When we were starting, there was that image that had people. There was one controlling the tap, one holding the pipe, and one at the very end where the cash was flowing out. For you to have these people that get to interact with your finances, be effective in their leadership, there are these three things that are outlined here that you can implement. First of all, you need to have a strategic vision. You develop a strategic vision for your financial leadership. A strategic vision is a long-term objective of or where you want your finance team to be in the future, or by the end of this year, you want your company to be this way or that way, no matters cash flow. You are the one who can draft it now. You come up with a strategic vision that will help your organization towards its journey of sustainable growth. Yeah. And then number two, team alignment. Getting the right team. Aligning the team with whichever team you recruit into your finance team or people who will be handling your business operations. You need to align them with the organizational objectives or rather the strategic vision of the organization. When you align the team with the organizational objectives, it will foster a collaborative environment and they will be very productive because we came here with the same goal as as your business. We have where your business wants to be in the next 5 years is where we also want it to be, and now it gets easier for your business to grow and have a healthy cash flow. And then number three, we have adaptability. Adaptability we mean being flexible. Yeah, we know change is inevitable. So um, for for your financial strategy to be effective or to meet the standards, you have to be adaptable and very open to change because in these times that we are, the finance field is rapidly evolving and things change every day. You sleep today, you wake up tomorrow, you find there's something that has changed that is totally different from what was there yesterday. Now, when we're not adaptable when we're not flexible, we end up being irrelevant in the market and you will be overwhelmed by these market dynamics because before you realize everything will have changed in the end and you will just be where you were from the beginning. So we should all be open to change and even as we even as we think about making our cash flow for our businesses improve. Yes, now we have a liquidity risk. The challenge of liquidity risk. Liquidity risk we define it when you are starting and we got that it is the risk that maybe the business might not be able to meet its obligations in the end or might not be able to have assets that we can easily convert into cash in the long run. Yeah. So some of the challenges that might cause this lead to this liquidity risk, we have market fluctuations. Our market fluctuates every day. And when the market continues changing and is very unpredictable, it it has a great impact on the ability of the firm to meet its short-term financial goals, especially if the firm is not yet stable, it will be really affected. So one should be keen on the trends in the market to avoid being affected by this liquidity risk. And then number two, funding disruptions. When our funding sources, whether it was equity financing or debt financing, when they're disrupted, it can lead to liquidity challenges and that will underscore the importance of strategic planning because yes, maybe you had a strategic vision, maybe you had planned very well for the financial health of your business, but when when your funds get disrupted, you can easily go down and your cash flow will automatically decline. So when when we are faced with that or when your funds get disrupted, you should always have an alternative. You should not just depend on one source of fund for your business. You can have multiple, you can mix both the debt and the equity ones for for the good of your business. Yeah. And then the third one we have operational constraints. Operational constraints are these day-to-day activities in our business. Now, these day-to-day activities can also affect the liquidity of our businesses because they they will bring instability when a business operation or the normal operations of a business are distracted. We we will realize that the business will not be going the way it should go. For example, even in a river, when a bend is created, when a river was just going straight, and some small bend is created towards maybe the left or the right, you'll get that some water will start diverting to that side. And that is the same case with operational constants. In case of any operational constraint, the the business will be exposed to a higher risk of liquidity. And to deal with this, you should always give room for such. When you're drafting your plans for a year, or you're as an operations manager, you're coming up with just your plans, you need to give room for such constraints and have backup plans just in case a constraint comes along the way. And to the next one. I don't know if you can see up there. It's the topic is implementing robust risk management strategies. Implementing robust risk management strategies, because on the preceding slide we have talked about liquidity risk. Now we want to see how you can implement robust risk management strategies. The very first one is to identify the risk, and by identifying the risk that you thoroughly look into your financial operations in the markets, then you that means look into the business internally and externally, so that you get to know which risks might affect your business. And then number two, you evaluate the impact. When you evaluate the impact of whichever risk you have initially assessed, when you evaluate the impact, you will know that this might affect my company in this way, and this might affect my company's financial health in this way. And with that, you will be able to know how to handle each of them. You can even end up avoiding the one that will end up making your cash flow decline terribly, and work with the one that works to your favor. Yeah. And then number three, you implement measures. By implementing measures, it means you implement the robust measures to mitigate and manage the identified risks effectively. These measures you cannot come up with them on your own. That is why initially we have discussed that you need to talk to mentors, you need to consult experts, you need to learn a lot, you need to continuously enhance your knowledge. Like this, you'll be able to get to know very many measures on how you can deal with the various types of risks that might affect your entity. Yeah. Now we have the importance of asset liability management. When we were starting, we discussed what's the meaning of asset liability management. Now we want to look at its importance. The very first importance is that it brings balance and stability. You remember in our definition we had a part that is saying when there's a mismatch between the asset and the liability. So when you are able to manage your assets and liabilities well, you will get to balance them and stabilize your business. And this will ensure that there's a balance between the short term and the long term obligations, or other loans or debts or payables of your business. And this will provide the stability to your business's financial structure. Yeah. And then we have risk mitigation. The asset liability management also helps in mitigating risks, especially the interest rate risk, the liquidity risk, the overall. We're going to discuss these risks in the coming slides. So it helps you mitigate all those risks and safeguard your business from sudden financial upheavals. Yeah. And then the third importance is that you are able to optimize your business performance when you align your assets and liabilities well, or when you align them efficiently. Your business can be able to optimize their performance, and when a business performs well, then automatically its financial health will also be well. Yeah. So So I have just said that you're going to talk about the risk that I've just mentioned previously in the coming slide. So these are some of the risks that can be mitigated through ALM. ALM in full is the asset liability management. So the very first risk that can be mitigated through ALM is liquidity risk. And we have really repeatedly discussed liquidity risk. So I'll just explain the next one. We have the interest rate risk. An interest rate risk is a risk or the potential impact of changes in the interest rate on the value of the financial instruments or investments in a company. The interest rates in our markets keep changing. If you are very keen on the maybe MMFs or you read the business news, you will realize that interest rates do change frequently. Yeah. Another one is the currency risk. The currency risk can also be termed as the exchange rate risk. This example is the recent one, the Kenya and the dollar, the Kenya shilling and the dollar. Yeah. So the exchange rate risk is the potential financial loss that can occur due to the fluctuations in the value of one currency relative to another. Yeah. And then the third risk that can be mitigated through ALM is capital market risk. And the capital market risk is the potential for financial losses arising from fluctuation in the prices of financial instruments traded in the capital markets. For example, in Kenya, we have the Capital Markets Authority. So those financial instruments that are traded there can also be a risk to your company if you don't manage your assets and liabilities well. Yeah. So now, towards the end of our presentation, I have 3 ways that we can use maybe to improve our cash flows apart from the asset liability management one. We can, first of all, employ agility. And with agility, it means we need to adopt very, very agile financial strategies, and these agile financial strategies will make our businesses flexible to the dynamic changes in the market conditions out there. Yeah. And then number 2, technological integration. By technological integration, we will be able to get to analyze our financial management in our company, or rather look at our cash flow deeply using the various technologies that we have nowadays, the advancements. We can use them to analyze that and provide a competitive edge so that we are able to remain relevant in the market, or rather be at par with our competitors. Yeah. And then the third one is innovation. When we foster a culture of innovation, rather creativity in our businesses, it will help in continuous improvement in our financial strategies, and again help us remain relevant in the market so that we are not overpowered by our competitors. We remain at par. Yeah. And just to conclude on today's presentation, I'd say that in navigating the challenges of cash flow decline, effective asset liability management strategies play a very crucial role, just as we have seen. Yes, this was just, I'd say, an introduction, but at least we have seen how crucial it is, and it helps in aligning the assets and liabilities and help mitigate the liquidity risk and ensure that our businesses are stable financially. Yeah. And the second conclusion is that by proactively managing liquidity risk through the the asset liability management practices, organizations can safeguard against the impacts of cash flow decline and optimizing and enhancing their ability to weather uncertainty in the financial landscape. So thank you all for being part of this presentation today. that marks the end of my short presentation today. Maybe when we get a chance next time, we'll delve deeply into this. Yeah. So I think I'll take it back to Eugene to know whether there are some questions or comments. Yeah. So Eugene, the mic is yours.
Thank you very much, Daphne, for the wonderful presentation. So at this point, I'd like to welcome any question. Please, you can. Uh, mm, any question? Do you have any question? Okay. I'd seen Samuel and raised up, but in case he has no question, we'll then proceed to the parting shot. Before I welcome Daphne for the parting shot, I'd like to remind you of the upcoming session. I will have an upcoming session which will be based on data protection. Now, with so I will welcome Daphne. Yes, Jet, are you speaking? Okay. I would like to welcome Daphne to give her parting shot, then we'll be able to complete it. Thank you.
Cutting short, okay. So thank you all for creating time to join the webinar today. I have seen two of us comment, Robin and Esther. Thank you so much for the comments. Indeed, the presentations will be shared with each and everyone who registered for the webinar. It will be shared to your email, so don't worry about that. I want to also thank Eugene and the whole team from Capable for inviting me to share today. It was a very great opportunity, and I hope each and every one of us learned something, if not two. Yeah. Otherwise, I'm grateful and have a fruitful day for the remaining part of the day, everyone. Hey,
All
Eugene,
right.
back to you.
All right. Thank you very much for the well research, very informative presentation as given by Hilary Kiprotich. So we are going to end it here. So feel free to leave. Feel free to follow us back in case of any concern, any questions, and in case you want to access and subscribe to our services, please reach out to us at info@capable.com. I want to wish you wonderful afternoon. May you enjoy your lunch, even as we continue our learning. Thank you very much.